Assalamualaikum and selamat sejahtera. So the topic of my presentations in this video is on the introductions to financial management. There are four learning outcomes of these topics. So at the end of the lesson, the students should be able to define the financial management and give examples of financial activities. Secondly, students should be able to explain the various components of financial environment. And number three, students should be able to describe the functions of financial management and the responsibilities of the financial managers. And number four, able to explain why shareholders' wealth maximization is more relevant than profit maximization. Okay, next is what is finance? Finance is the applications of the principle of financial economics to an interrelated set of monetary problems. So this is a process by which the money is transferred among businesses, among individuals, and also governments via the financing and investing activities of these parties. So importance of finance, it allows better communications among departments. Next question is what is financial management? Financial management is about the study and practice of money related decisions within a firm. So financial management relates to management activities that are concerned with planning and controlling of financial resources involved in balancing the risk and profitability. There are three categories of finance, that is the personal finance, the public finance, and the managerial finance or corporate finance. So personal finance is for individual like all of us. Each of us considered as personal finance. And then the public finance, that is the government. And then the third one is the managerial finance or institutions, corporate bodies, etc. So the decisions functions can be broken down into three major areas. The first one is investment decisions, and then the financing decisions, and then the third one is asset management decisions. The first area of decision functions is investment decisions. Investment decision is to determine the total amount of asset needed through capital investment and also working capital investment. For capital investment, normally it involves large amount of money, non-routine and normally critical. For example, the decisions to acquire new assets such as machines and plants. Or for the working capital investment, it is more routine and usually take place on daily basis. For example, in determining the amount of inventories, cash, account receivables, and marketable securities to hold. The second area of decision functions is financing decisions or the deciding on what sources of finance to finance the investment decisions. So the financing decisions determine how to finance those assets through short-term or long-term borrowings or by issuing of shares, the common stock, preferred stock, and also the internal financing, that is the use of retained earnings. And the third area of decision functions is asset management decisions. Asset management decisions is To determine how to manage assets efficiently in order to increase return from investment and to reduce the risk of illiquidity. And there are also a few components of the financial environment. The first is financial managers. The financial managers are responsible for deciding how to raise and invest the company's fund. And they are also expected to make decisions on what that will maximize the stock price and the firm value. The second component is investors. Investors represent individuals or financial institutions that provide funds to firms, government agencies, or individuals who need funds. Financial institutions that provide funds to firms are called institutional investors. And the third component of the financial environment is financial markets. Financial markets represent forums that facilitate the flow of funds between investors, firms, and government units and agencies. So these financial markets can be broken down into money market and capital market. And the fourth component of the financial environment is the financial institutions. Financial institutions serve as intermediaries that channel the saving of individuals, businesses, and governments into loan or investments. So these include commercial banks, saving institutions, insurance companies, pension funds, finance companies, and mutual funds. Okay, next is the responsibilities of financial managers. So basically, the financial managers play a very important role in the financial management. So these are the list of responsibilities of financial managers, that is forecasting and planning, investment and financing decisions, coordination and control, and dealing with the financial markets. There are two basically goals of firms. First is maximization of profit, and number two is the maximizations of the shareholders' wealth. Profit maximization stress the efficient use of capital resources. It is not specified to time frame for profits to be measured. As such, goals are not precise, and it allows for misinterpretations. And it also ignores uncertainty and timing. Profit is the amount of revenue remaining after deducting all costs and expenses. The expenses include non-cash items such as depreciation and amortization of fixed asset. So it can be achieved in short term, less than 1 year, by either increasing or decreasing the variables such as sales unit or sales price. And it emphasizes on the amount of profit and not on the profits are received. Profit maximization, increase in profit does not mean an increase in cash, and it ignores risk and uncertainty that comes with the project. Risk is defined as the possibility that something unpleasant would occur or the probability that the actual results would differ from the expected result. However, there are also drawbacks of profit maximizations. Number one, it is a short-term concept, that is, it must be achieved within 1 year. For example, assuming a company intends to increase its profit, so either by reducing its investment in research and development or by postponing major repair. The reductions in R&D or postponement of major repairs may result in future decline in sales and profit. And number two, it does not consider the timing of returns. The timing of returns may refer to how quickly a firm earns a return from an investment in fixed assets. For example, assuming a company has two projects with the following earnings. There are two projects, project A and B, both generate the same earnings, that is 250,000, but project A earns all the earnings in the first year, whereby project B generate the earnings in the second year. According to profit maximizations, project A is equal to project B since both projects generate the same earnings. However, according to the time value of money concept, the two projects are not equal because the sooner A receives the earnings, the sooner it can be invested to generate returns, and the higher the value of the money. Number three, it does not consider risk. Risk is defined as chance that the actual result would differ from the expected result. For example, we assume a company is considering two mutually exclusive projects with the following earnings. Both projects earns the same amount of income, that is 900,000 each, under three different economic conditions. If you look at the example for project A, each economic conditions under booming, average economy, and recession, it has equal amount of income for each conditions, whereby for project B, it can only generate income, a huge income in the when it is booming, the economy is booming, and there is none during recessions. So you can see here that the project B has the high degree of uncertainty or risk, as it may not be able to make any profit if the company is in recession. According to profit maximizations, the two projects are equal since the average earnings for both projects are 300,000. Rationally, the two projects are not equivalent because project B has a high degree of uncertainty compared to project A. Project B may not be able to generate earnings if the economy is in recession. Good decisions are those that create wealth for the shareholders, societal benefit as businesses compete to create wealth, and it includes effect of all financial decisions. Shareholders' wealth refers to the market value of common stock held in the company, and it has to achieve all the short-term targets such as increase in profit, growth in earnings and dividends, and maintain financial stability so that the firm will be more attractive, thereby resulting in an increase in demand for the firm's common stock, which follows with an increase in the share price. It applies the principle of time value of money, in which a dollar received today is worth more than if it is received in 10 years' time. Decisions are made after taking into account the uncertainty or risk factor. So increase in wealth is related to the increase in cash flow. So there are advantages as well as disadvantages of profit maximizations. The advantages are it's easy to calculate, it's very simple, not complicated. The second advantage is easy to determine the link between financial decisions and profit. And number three, it stressed on efficient use of capital resources. However, there are four disadvantages of the profit maximizations. It emphasizes on short-term target, therefore it ignores long-term. Secondly, it ignores risk and real-world complexities when making financial decisions. Number three, it concentrates on total earnings, not the EPS. Number four, it ignores cost of funds provided by shareholders in computing the profit. And there are also advantages and disadvantages of shareholders' wealth maximizations. The advantages are it emphasizes on long-term returns. It also considers risk when making financial decisions and consider the timing of returns. It takes into account the economic expectations since it affects movement in stock price. And number five, it concentrates on earnings per share. And there are also disadvantages of these shareholders' wealth maximizations. For example, the goal does not offer any clear relationship between stock price and financial decisions. And number two, it may take a long time to achieve. And number three, to maximize earnings per share, the firm may have to implement a dividend policy that may never pay dividend. And the last part of this introduction is the legal form of business organizations. So basically, there are three form of business organizations. Number one is sole proprietorship. Number two is partnership, and number three is company or corporations. There are differences between sole proprietorship, the partnership, and also the private limited company in the form of structure, formations, registration, shares, limitation, etc. In terms of structure, the sole proprietorship is owned by one person and the partnership is owned by two or more individuals. But for private limited company, it is a separate legal entity with a maximum of 50 shareholders. In terms of formations, for sole proprietorship, it is formed by the owner himself. For partnership, it is formed by the partners themselves. And for private company, appoint management firm to execute the formations. And normally, it is done by company secretary. In terms of registrations, both sole proprietorship and partnership are registered under the SSM. Okay, registered with the SSM under the Registration of Business Act 1956. Meanwhile, for private limited company, it is registered with the SSM and but under the Companies Act 2016.